Hi there, my name is Rod Caldwell and today we're going to be talking about debits and credits. This is an accounting concept which means that you've either started your first few weeks in Accounting 101 or an equivalent bookkeeping course, or you have just bought yourself a computerized accounting system and have come across this term for the first time. You may notice that my accent is that of an Australian. And you may be in England, or you could be in France, you could be in China. That doesn't matter, because accounting is the one universal concept that applies irrespective of which country you're in. Even the United States recognizes the international financial reporting standards that have been set so that every company, especially those with international affiliates, record their bookkeeping and accounting in exactly the same way. So having said that, let's get started on debits and credits. Traditionally, you would start a discussion of debits and credits with something like a ledger account that we can see on the screen currently. Now, I am not going to do that. We are going to start instead with the history of accounting, because it is the history where these terms actually originated from. Accounting was first invented by the Persians 3,000 odd years ago. Later it was taken to Egypt and then to Rome and the Roman Empire, and eventually we end up with a monk in about 1490, a monk in a monastery in northern Italy, and he has been given the job of accounting for the wine sales. Monasteries typically funded themselves through sales of various spirits and so forth. In this case it was wine. His name was Friar Lucia, and he had two problems. The first problem was that a wine barrel is not an exact cylinder. In actual fact, it's sort of bloated. How do you work out the volume mathematically of something like that? Well, he thought about it for a little while, and he decided you could derive the volume from the mathematical equation of the curve of the barrel. And he came up with a mathematical concept called calculus. Now, calculus is with us today, and it is a very advanced mathematical concept devised by this fella simply because he wanted to know how much wine was left in his barrel in order to sell it. What he had created is what we would call today an inventory system. That is, he was able to account for his wine by volume of sales, but his other problem was, how do you account for the wine sales in dollar terms, what today we know as financial accounting? To resolve this, he actually went down to Venice, which was a local town, a city-state. And in Venice, he talked to, first of all, the moneylenders, because he was trying to resolve a financial problem. The moneylenders introduced him to their cash ledger. The cash ledger had two sides to it. One of those sides had the word debere on it, which was for the depositors, and the other side credere on it, which was for the borrowers. So it was a matter of, some people would deposit money with the money lender, who would then on-lend it to other borrowers. Now, the term debere actually means to owe, which sounds a bit strange, but if you think about it, if someone was to deposit money with you as a money lender, you then owe them that cash. The other side of it was credere, and that basically means to entrust. This was for the people who would borrow money from the moneylender, and the moneylender would entrust them to repay it. So that's where the Latin roots of what we today know as debit and credit arise from. You will also notice that when debere was converted into English debit, it still retained the dr of the original Latin root as its symbol. Credere, exactly the same. It went to credit, but it retained its cr as its symbol. Anyway, back to our monk. He went down to Venice, he saw the money lenders, and they introduced him to these terms, but he wasn't there as a borrower or a lender. He was there as a merchant selling wine. That's really what he was doing. Although he was a priest in a monastery, they were still acting as a merchant selling wine, so he was selling goods. So then he went to the merchants who were dealing more in physical goods and talked to them. Now, they didn't really have an accounting system as such, but they did come up with this interesting concept. And what they said was they were mainly bartering. And what they would do is they would enter into an agreement with one of their customers, and their customer, for instance, might have 2 pigs for which they desired a goat. The merchant might have a goat and thought the idea of these 2 pigs was a good idea. So they would come to an agreement where they would basically swap the pigs for the goat. And what the merchant said was that every transaction that they do like this is of equal value on both sides, that as far as the merchant is concerned, the 2 pigs are equal to his 1 goat. As far as the customer is concerned, the 1 goat is equal to the 2 pigs, so both of them walk away quite happy. But they said, although that was where they've come from, today they tend to more, and when we're talking about today, remember we're talking about 1494 back here, what they tend to do is enter into these agreements in coin, that is, in money. So they will agree that the 2 pigs might be worth $100, but they'll also agree that the goat is worth $100. So they'll have this transaction where the 2 pigs for $100 are traded for the 1 goat for $100, and everyone is happy. So we have this idea that you have a transactions in business that they're two-sided and each side has equal value, and that they can be converted into money or expressed in monetary terms, in what we would today call dollar terms. So we have that. And then the merchants brought up another idea. They said, look, the way in which we value ourselves, how much am I worth as a business? He said, they came up with the idea of this idea that everything could be valued, and it was the total value of everything they owned was the value of the business. So we're not talking money here, but we're talking about goods which are valued in money terms. And this is quite important for financial accounting, because in financial accounting it's only the cash at bank account which actually represents money. Everything else represents some physical good or a right or something of that nature which is expressed in monetary terms. So you would, for instance, buy the 2 pigs for $100, so you record the purchase as $100 and the fact that you now owe your client $100. You would then record the sale of the goat for $100 to your client, and the $100 you owe and the $100 he owes you would be offset, and everyone is happy. But it's all in dollar terms. This led our priest now to start to think, well, how can I use both the concepts of debits and credits, the concepts of transactions having value, and the idea that in business it is all about transactions which are double-sided, and both the one side and the other are both exactly equal, what the money lenders would call the debit and the credit. And this is where our monk came up with the concept of bookkeeping as we know it today. Let's now fast forward to today. We go down to our local shop and we decide that we want to buy ourselves a pair of shoes. Now we have to look at this transaction from the business viewpoint, not from the viewpoint of an individual. So we're down at the local shop, we see our pair of shoes, very expensive at $25. So what is the transaction that's going to take place? Well, when you go to the counter with that pair of shoes, you'll place them on the counter, the clerk will bag them up and then will hand them back to you on the provision that you pay an amount of money, that is $25. You could pay this today in cash or more likely by credit card, but let us just talk about cash for now. So what's happened here is they have given you the inventory, their trading stock, that is the pair of shoes, and you have given them $25. So as you can see, it's a business transaction. It is two-sided. You have gained something, but you have given something for that. And both the value of what you've given and the value of what you've received has been identical. Now from the merchant's viewpoint, they have given you trading stock to the value of $25 and they call that a sale. So they've made a sale to the value of $25, which is a credit. What they have done is they've received from you cash, and they call that a debit. They receive from you cash. So we have a credit to the sales account of $25 and a debit to their cash at bank account of $25. It is the one transaction. It is equal in both sides, and there is a debit and a credit. Bear in mind the debits and the credits must equal in every transaction, but they don't have to be equal in number. You might have 2 or 3 debits being recorded for only one credit, or vice versa. As for an example, if you have taxation added to the payment, so you would be breaking it down into the cost of the goods plus the VAT or GST, and for that that means you have 2 credit amounts, one being the cost of the goods, one being the GST, and for that you'll receive the one amount of cash for the total, which will be a debit. So 1 debit line to 2 credit lines. But the important part of it is the debits in total must equal the credits in total for each and every transaction. And that's what we're having here. We have bought ourselves a $25 pair of shoes. So we're happy, we have shoes to the value of $25, and we have parted with our hard-earned cash to the merchant. The merchant is happy. They have departed with the merchandise, the inventory item, their shoes, and they call that a sale in financial accounting terms, and they have received for that $25. But bear in mind, this is only the financial recording system. There's also, in parallel to this, the inventory system, and the inventory system would be recording 1 pair of shoes out. But that is a separate system to what we're talking about. We're talking about accounting, bookkeeping. That is the financial side of it, not the inventory side of it. So now let's have a look at what it would look like as a ledger. And here it is here. Notice that we have cash at bank, and on the left side is where we put all the debits. That is the amount coming in to us as the merchant is $25. And on the credit side we record that which is going out of the business, that is the shoes, and they are worth $25 to our sales account. So we have $25 in cash in, and the shoes being our sales of $25 credit out. Debits must always equal credits. What you'll also notice is the way in which these ledger accounts are set out. Date, detail, amount on the debit side, date, detail, amount on the credit side. These are known as T accounts. And this is what it looks like in a manual recording system. Unfortunately, when we went into computerization, computers didn't like the look of this at all. So what we did is we have changed the layout slightly of these ledger accounts. And for computerization, a ledger account still has that same sort of T as you can see there, but you have the debit and the credit, and now you have a balance account. See, the problem with the old-fashioned idea was you could never know what the balance of the account was until the end of the period, when you added up the debits and the credit and took one away from the other and came up with a balance. In the modern ledger accounts, as you can see, you have a balance column which is continuously being updated, so at any time at all you can always tell what the balance of the account is. Well, that was a very short introduction to the topic of debits and credits. In my next video, I'll be talking about account classification, things like assets, liabilities, sales, expenses, plus quite a few others. And once we talk about account classification, and especially the chart of accounts, we can then start to talk more in depth about how debits and credits interact with these ledger accounts. After that, we'll then talk about ledgers and journals and how they apply in our computerized world.